Well, it's time to check your money with America's money maven, Vicki Brackens. Vicki Brackens is president of Brackens Financial Solutions Network, LLC, and a registered representative of LPL Financial Corp, member SIPC. Vicki, good morning.
Good morning, George. Happy to be back.
Good to see you. So you were like stranded last week.
Yes, I got stranded in San Diego, of all places, trying to get back to the East Coast with all those storms and all those other things that were happening.
Yeah.
So after about 27 hours, I finally made it home.
Well, I'm glad to see you in the flesh today. We had to do a remix last week.
Yes, we did. But I'm going to talk about something, starts with an R, like remix, okay? But I'm going to talk about this week your refund.
Uh-huh.
And what may have happened to your tax refund.
Yeah.
So before I start, everyone listen to me very carefully. This is not specific tax advice.
Mm-hmm.
Seek specific tax advice from your own personal tax advisor. But about half Americans, okay, as far as the statistics are concerned, George, actually get a check. They actually get a tax refund. In the past, about a third of those people usually saved or invested that refund. And then another 30% or so say that they would use it to pay down debts. And the remaining third would use it to do things as far as necessities or purchase big-ticket items. You know, the average refund in the past has been roughly about $3,600.
Okay.
And when you look at the average income in a household, that usually equated to something like 5.7 weeks of take-home pay. So that was a very significant cash infusion into the budget. Now I want to look at some new realities.
Uh-huh.
The Tax Jobs Act, or the Tax Cut and Jobs Act of 2018, you might see because of that your refund this year is smaller. So what do you do?
What do you do?
I mean, is that really fair? What do you think, George?
I don't think it is.
Are you going to be able to survive?
Depends on what you tell me next.
Okay, or do you think it's because of tricky politicians?
I think it's tricky politicians, and I think the rich are getting richer.
All right, then. Well, listen, I think we should debunk some of those things that we feel and think.
Okay.
Because what you may not have realized is that after that act was passed, most of us got an increase in our net take-home pay. Did you know that?
Yeah.
You really did?
Not really.
Okay. Okay. So, George, here's where it gets really tricky. When you think of a refund, what is really a refund?
Basically, you're withholding money and giving the government an interest-free loan that you get at the end of the time that after you file your taxes.
Okay, so that really means you're getting back whose money?
Your own money.
You're getting back your own money.
Right.
Okay, so a lot, this is where psychology and money really have an overlap. Because we're getting it from a government check or getting it from another source, we feel like someone is giving us something. But the truth is you're actually getting back your own money, the money that you overpaid, not more money. You're just getting a return of your own money. So if the tax brackets throughout the year were lowered and you got more money in your paycheck immediately, is everything wonderful? Do you feel like that's wonderful?
It should be wonderful, yes.
It should be, but here's the other tricky part about that. In order for it to really be wonderful, you have to retain that extra money.
Uh-huh.
So you have to look at this in this frame. You need to collect the extra money over the 12 months and then compare it to what you received last year in your tax refund. And then at that point in time, side by side, you can actually see whether or not you have the same or equivalent amounts, and now know that your taxes have actually gone down. So here's the thing that I think is really hard. So right now I'm telling everybody to compare. And unless you saved your pay stubs, which some people do.
Well, right now, so most of us have we have access to our pay stubs online.
Thank you. That's what I wanted you to do.
Thank you.
Okay,
yes.
Go online, find your pay stubs.
Right.
Look at the change that took place last year between your 217 and your 218 take-home pay. Now, if you got a raise, it's going to be a little bit tricky as far as how to calculate
Most of us did. You would hope, right?
Yes, we would hope. Okay, but look at what was there, and you should see an increase in your net take-home pay. that means that the refund that you receive this year possibly, I'm not guaranteeing it, but possibly will be smaller. And in a few cases, you may not get a refund at all because there was a prepayment because of the brackets lowering of those monies throughout the year. So how are you going to make up for that fact is the question. Because one of the things we've noticed is that individuals have actually been using the refund process as a way for forced savings.
Right.
They've actually been looking at, I'll catch up my bills with my tax refund.
Absolutely. Okay? Or I'm going to buy the car. I'm going to do the refrigerator, the home improvement.
All of those things. Okay?
All of the above.
All right. So here's where we have some issues that we're going to have to sort of smooth out over the next 12 months. The first thing is, I find in working with clients all of these years that we improperly schedule our budgets. Here's what I mean by improperly scheduling our budgets. You say, I make $60,000 a year. Me and my wife together, we make $60,000 a year. That equates to $5,000 a month. We add up all of the expenses that you have, and let's say it's $48,000 for all the year that you spend. And you divide by 12, and that gives you $4,000 a month. And then there should be some surplus, 48 minus 60, there should be surplus, right?
Right.
The problem is our expenses, even if they're 48, are not evenly dispersed throughout the year.
And you have things like car repairs, roof leaks, and
things. Even without those discretionary numbers, okay?
Right.
If we looked at our actual fixed expenses and they were 48, the expenses themselves do not come in even increments.
No.
We have things that come in on lump sum. And when those things come in lump sum, if we have not prepared and have that extra money sitting there, what's happening is that we're putting it on the credit card.
Like property taxes and things like that.
Property taxes.
Right.
Or the auto insurance or the homeowner's insurance. If you don't have those types of things escrowed. So what I would suggest for everyone, first of all, so we can work through this system together. Suggest.
Hello.
Okay, is
yes.
that you start setting up what I call an expense flow schedule. Look at all of your expenses for the year, and actually each month go in and chart in what the expenses are for every month.
Right.
Versus just saying that it's an even distribution of $4,000 a month. Because some months it might be $4,000, it might be $2,800, next one may be $5,100. It averages $4,000, but you cannot plan what's called your cash flow
based on that
unless you actually look at per month what those expenses are, so that you can set aside the proper amount of cash in order to take care of those things. Now, what do we do to get out of the hole that we're in for this year?
Yeah. In
case we don't get a refund or we get less than we planned on. So I'm giving everyone some homework for next week. I'm not going to give you the answer, today, because we need some data in order to help you work through this.
You are a data queen.
Okay, all right. So what I'd like for you to do is to go back, first of all, and compare your last pay stub in 2018 to your last pay stub in 2017.
Okay.
So you should be able to see that differential as far as your take-home pay is concerned. Then I want you to do a 12-month expense flow worksheet. Excel is a great program to do this. In fact, I think Excel actually has an expense flow calculator in there. But if not, just do a basic Excel sheet and actually go through for 12 months, calculating out exactly what the expenses are for that 12-month period. You should see lump sum expenses, because we all have those things that come not once a year, but come every 6 months, or come every quarter. Next week, based on that information, we'll tell you how to, first of all, dig out of the hole that you may have because you expected the cash refund through your taxes, and what we can do going forward.
What about people who have those expenses taken out of their check before they see it? So
I'm happy for those people.
You're happy? Because I'm seeing a lot of people do that, and with that, sometimes that makes it harder to calculate because I'm getting the deduction for the expense that's I know I'm going to have, like my homeowners perhaps or
Right.
whatever it is.
Okay, so if you already have homeowners coming out in your escrow payment, that's
Yes.
what you're talking about,
Right.
then you're not going to have a lump sum in that category. But you may have something else that comes as a lump sum, like your kids' tuition bills.
Oh, Lord. Yes, they do come in lump sum.
Okay, all right, okay. All of a sudden, we can't breathe in August because those tuition bills are showing up. We need to set up expense flows throughout the year so that we can evenly prepare for those types of things. So there's usually something that is coming in lump sum that's throwing off the budget as far as what happens in our actual cash flow that forces us to use credit cards to cover certain months because our cash in doesn't meet our cash out.
Okay.
So I'll stop right here. I'm looking forward to hearing from everyone. You can reach out to us at info@Brackens Financial Services Network or brackensfsn.com or 315-930-4499. And at this point, George, I'll say our plate is full.
All right, Vicki Brackens, and of course, this money segment brought to you by Brackens Financial Solutions Network, LLC, where Vicki Brackens is the registered representative of LPL Financial Corp, member SIPC.